Welcome back to the deep dive. We've got the AI IntelliTraders team report right here, fresh off the press for the week ending October 31st, 2025. And it looks dense, lots of data on futures and microfutures performance.
It is packed, yeah. And our mission today, well, it's pretty straightforward. We're going to cut through all these raw numbers, pull out the key insights for you.
Right.
We're not just reading lists. We're looking at what the high volume really means, why some implied volatility is so low, checking out these extreme valuations from price contraction and, what the movie averages are hinting at.
So basically the essential shortcut for anyone trading derivatives trying to make sense of the close.
Exactly. That's the goal.
Okay, let's jump right in then. Where did the money flow? Always start with that snapshot. The top 5 contracts by daily volume, what dominated as October wrapped up?
Well, the answer is pretty stark, actually. Fixed income, bonds. That's where the action was.
Really? Dominating the tape.
Oh, yeah. If you want to know where the big institutions were focused on Friday, it was managing risk in the bond market. 3 of the top 5 were Treasury products.
Okay, let's run those numbers then. This really sets the scene, doesn't it?
It absolutely does. So, leading the pack, number 1, not an equity index, but the 10-year U.S. Treasury note futures, ZN. Huge volume, 1,833,505 contracts traded.
Wow, okay. And the IV rank?
Tiny, just 5%.
Wait, 1.8 million contracts and only a 5% IV rank. That's quite a contrast. Massive liquidity, but the options market is basically say nothing to see here in terms of expected future pops.
Precisely. Huge flow, low implied vol. Behind that, number 2 was the E-mini S&P 500 ES. Still big volume, 1,653,625 contracts.
Okay, more what you'd expect near the top, and it's IV rank.
A bit higher, but still relatively low. It's 17%. But think about that. The main equity index was trailing the 10-year note by almost 200,000 contracts.
That tells you something right there about where the big money was focused this week.
It really does. Number 3, back to bonds. The 5-year U.S. Treasury note futures ZF volume was 1,275,035. And check this out. IV rank was the lowest on the list, just 3%.
3%? Seriously?
3% on over 1 million contracts traded.
That's profound, isn't it? What does that
Yeah.
even signal? Massive confidence or maybe just huge hedging?
It's one of those, gigantic participation, but almost zero expectation of turbulence in the middle of the curve, at least relative to its recent history. Could be confidence, could be very large, coordinated hedging driving things. Hard to say just from that number.
Okay, who rounds out the top 5?
Number 4 is the E-mini NASDAQ 100 NQ volume, 579,791 contracts, 5E rank, 22%. So a bit more expected vol there.
Makes sense for the NASDAQ.
And number 5, finishing the list, another Treasury. The 30-year U.S. Treasury bond futures ZB volume was 421,954 with an IV rank of 9%.
So the big picture from the get-go. Treasuries grabbed 3 of the top 5 spots by volume, all with super low IV ranks, like under 10%. Meanwhile, ES and NQ provided the equity action.
Yep. The story of the close is high institutional activity, but it seems focused on managing yield curve risk, maybe repositioning, rather than wildly speculating on big moves.
Yeah.
That low implied vol across the 5, 10, and 30-year is critical. It means option sellers weren't getting paid much to take on risk there.
All right, so if bonds were, let's say, signaling quiet chaos with that high volume, low vol mix, how did that vibe translate to the big equity indices? Let's dig into the S&P, ES, and the NASDAQ and Q. Are they looking healthy underneath?
Well, the baseline news is good for, longer-term holders. Both ES and NQ are trading clearly above their 200-day moving average. And importantly, they're also above the 200-hour moving average, too.
Okay, so both the long-term and the shorter-term trends are technically pointing up. That's solid support.
It is. That dual confirmation is a strong signal. The structure looks intact.
But I see some hesitation here in the details for ES. Daily volume on Friday was only 93% of Thursday's, a little pullback. Weekly volume held up, though, 103% of the prior week.
And that slight hesitation, it gets amplified when you look at the buyer-seller power metrics for the S&P. The daily signal was seller UP.
Seller UP, meaning sellers had the upper hand into the close on Friday.
Correct. Selling pressure dominated the final session. But, this is key, the weekly signal was buyer down.
Ah, okay, wait, let's parse that. Weekly buyer down means buying conviction actually weakened over the course of the whole week, even though the price stayed above those key moving averages.
Exactly. It's a mixed signal, right?
Huh.
It suggests that while the longer-term trend is holding positive, the internal dynamics right now are maybe characterized by passive buying, but more active short-term selling pressure.
So that sounds like a setup for maybe some sideways chop, consolidation near the highs while the market figures things out.
That's a classic setup for it, yeah.
Yeah.
Potential ranging or choppy consolidation. The market's searching for a new direction without really breaking down that major long-term support yet.
Okay, now the NASDAQ and Q. Similar underlying strength, you said, above both MAs, but its sentiment picture is flipped.
Flipped, yeah. For NQ, the daily signal was seller down, but the weekly signal was buyer UP.
So buyers actually gained ground over the week in the NASDAQ, even if sellers pushed back a bit on Friday.
That's what it suggests. Buyers seem to be winning the weekly flow battle there, and that upward push on the week connects directly to its valuation signal.
Which is?
The NASDAQ is showing up as 5% overvalue based on the daily time frame analysis in the report.
5% overvalue. What does that mean practically for our listeners? Is it just price is high?
It's a bit more specific. It means based on the AI IntelliSystems true value metric, which looks at things like price contraction and the recent volatility range, the NASDAQ's current price is about 5% higher or hotter than its sort of statistical norm for this period.
Okay, so it's stretched a bit relative to its recent behavior.
Exactly. It suggests some expansion happened, which, might increase the risk for anyone chasing momentum upward right now, could favor some short-term profit-taking or mean reversion thinking. Also, the report flags NQ as M-trend, a medium trend.
Medium trend. So decent momentum, but not like unstoppable.
Right. Solid direction, but maybe not that relentless force you see in what the system calls a hard trend or H trend.
Got it. Okay, let's swing back to where the really massive flows were.
Yeah.
The Treasury complex. ZN, ZF, ZB. We know they led on volume, but had that weirdly low implied volatility.
Yeah, this is the real strategic puzzle from the week, isn't it? Usually huge volume comes with uncertainty, higher 5E. Here, it's huge participation, but low risk pricing. Let's zoom in on the 10-year note, ZN, that 1.83 million volume, 5% IV rank monster.
Despite all that trading, its technical picture looks pretty weak, actually. The report says price is below both the 200-day and the 200-hour moving averages.
Below both. That's a clear technical warning sign right there.
And the sentiment.
Unambiguously negative. Both daily and weekly buyer-seller directions are flagged as buyer down.
Wow, unanimous buyer down on that volume. So buyers are consistently losing ground even with all that activity.
That's the critical takeaway. It suggests that, yes, large funds are driving the volume, but it's likely not speculative buying pushing prices up. It might be structural selling, maybe long-term allocation shifts, or required hedging. They're active, but they're pressing prices down.
And the trend designation.
It's classified as end trend, no trend. Basically, it's stuck in a ranging environment under persistent downward pressure. Probably benefits range traders selling premium more than trend followers right now.
Okay, now within the bond complex, you mentioned volatility extremes and technical conflict, particularly in the 5-year ZF and the 30-year ZB. The 5-year had that rock bottom 3% IV and huge weekly volume jump, 127% of the week before.
Right, and both ZF and ZB showed what I think is the most critical technical signal of the week, the divergence.
Divergence between the moving averages.
Exactly. They're both trading above the long-term 200-day MA. So the big picture, the structural bull case, you could argue, still holds. Yeah. However, they're both trading below the short-term 200-hour MA.
Ah, okay. So if I'm a technical trader, that's a bit unsettling. The immediate momentum has clearly broken down, but the underlying long-term structure is still holding on.
You nailed it. That breakdown below the 200-hour is the immediate red flag. It confirms that the high volume we saw is happening alongside a sharp loss of immediate upward momentum.
Which makes that 200-day MA support even more critical now.
It's the line in the sand. If that fails to hold, especially with participation this high, that low IV rank we talked about might suddenly, evaporate. It could spike as the market realizes the structural support just gave way. And for ZB, the 30-year, the sentiment adds another layer of confusion. Daily buyer down, but weekly buyer UP.
So more mixed signals. Short-term negativity clashing with some persistent buying over the broader week. Sounds like a recipe for potential whipsaws.
It really does. Yeah. So the bond complex gives us this picture of maybe institutional indecision. High participation, low expected future risk priced in, but conflicting signals between the short-term trend and the long-term one. Definitely complex.
Okay, shifting gears. If financials were about conflict and indecision, what about commodities? You mentioned clear directional extremes there.
Yeah, particularly in energy. Crude oil and natural gas, they are like polar opposites based on this report's metrics.
Okay, let's start with crude. Light sweet crude oil, CL. The report is flagging this as extremely undervalued.
Extremely. It's showing a significant 17% undervalue based on the daily time frame analysis.
17%, that's a huge number. What does that signal? Like price is way too low relative to its recent behavior.
Basically, yes. It signals that relative to its recent volatility and range dynamics, the current price is seriously compressed or discounted. It often suggests the market has overshot to the downside, and mathematically, it might be primed for a bounce, a mean reversion.
But are the technicals supporting that bounce idea?
That's the conflict. No, they're fighting it. Crude is trading below both the 200-day and the 200-hour MAs, so technically weak.
And the sentiment.
Unanimously bearish. Both daily and weekly buyer-seller directions are seller down.
Okay, so unanimous sellers below key MAs, yet 17% undervalued. How do you trade that?
It's tough, Ron. Why is sentiment so weak if it's mathematically cheap? It shows a profound lack of buying interest right now. For a momentum trader, the technicals, below MAs, seller down, probably win out. You don't fight that weakness. For a contrarian, this is where you might start looking, but you have to respect that overwhelming technical resistance. It's a falling knife, potentially.
Okay, total opposite story in natural gas NG. You said volatility move there.
Big time. NG has the highest IV rank on our entire list here, 64%. And the report notes it's upward loading, meaning the skew favors upside volatility.
64% IV rank. That's pricing in some serious moves.
Huge expected future volatility. And unlike crude, its technicals and sentiment are all singing the same tune, UP. It's trading above both MAs.
And the buyer-seller power.
Both daily and weekly are buyer UP. Unanimous bullish conviction.
So nat gas, strong trend, technical confirmation, momentum confirmed by sentiment, and massive volatility expectation.
Wow. Plus, daily volume surged 119% of the previous day. It's like the textbook example of a market confirming a potential breakout, expecting big follow-through.
But that high IV volume means buying calls would be expensive, right?
Very expensive. The market's making you pay up for that high directional confidence.
Okay, quickly on metals. Gold futures, GC, anything stand out?
Yeah, actually, a pullback in liquidity. Gold's last week volume ratio was quite low, only 66% of the week before.
Where did the gold traders go? Back to bonds, maybe? Or into nat gas?
Could be. Capital seems to have rotated out. Sentiment's mixed too. Daily seller down, weekly buyer UP. That lands it in the non-trend, no-trend category.
Yeah.
So less conviction, less participation right now in gold.
All right, now let's hit those real volume outliers you mentioned, the soft commodities, huge surges in ag products.
Yeah, when you see weekly volume ratios jump like this, it's often not just regular trading. It suggests something shifted fundamentally. Maybe supply chain news, weather, geopolitics. Something sparked a major repricing.
Which one was the most extreme?
Wheat futures, ZW weekly volume was an incredible 216% of the week before. More than double the activity.
216%. And where's the value?
It's showing a significant discount, actually, 11% undervalue. And it also registered a gap down opening.
Okay, so gap down, huge volume spike and undervalue. That sounds like some serious bearish pressure hitting wheat.
It does. We saw similar, though less extreme, volume spikes in soybean futures. ZS at 141% weekly volume, and corn futures, ZC, at 140%. Corn also gap down.
But soybeans look like an outlier here.
Yeah, soybeans are interesting. Despite the ag sector nervousness, ZS is flagged as H-trend, a hard trend, meaning strong upward momentum, and it's actually 6% overvalue. So soybeans found some powerful buying this week, bucking the trend seen in wheat and corn.
Okay, finally, currencies. Euro FX 6E and Japanese yen 6J. What's the story?
Both are also flagged as H-trend, hard trend, so strong, persistent moves there. But different setups.
How so?
The Euro FX 6E had a gap down open, is showing 3% undervalue and has unanimous sentiment. Buyer down daily and weekly. Clear bearish pressure.
And the yen 6J.
Its hard trend is confirmed by technical weakness. It's trading below both the 200-day and 200-hour MAs. So both showing strong directional trends, just technically different configurations pointing towards continued weakness for both against the dollar, presumably, given the DX gap up we'll mention later. These aren't markets you want to be fighting right now.
Okay, definitely a lot to unpack there across the different sectors. Just want to pause here for a second. If you are enjoying these insights and this deep dive into the numbers, make sure to hit that follow button and turn on your notifications. That way you'll be the first to get our market analysis update each week.
All right, so let's try and pull back the lens now. Synthesize some of the most extreme technical signals we've seen across all these different sectors. Starting with that daily true value metric, the price contraction analysis. Where were prices most out of whack with their recent norms?
Yeah, we saw some wild numbers, didn't we? Especially in metals. What was the absolute biggest overvalue signal?
Yeah, that definitely belongs to Silver Futures SI. It's just a massive outlier. The report flags it at an incredible 47% overvalue based on the daily time frame.
47%, that's not just a little stretch, that's like way out there. For listeners, what does 47% overvalue practically imply, risk-wise?
It implies the price has expanded, almost half its expected range in a likely short period, probably because of extreme momentum, maybe combined with thin conditions. Sustaining that kind of mathematical expansion is, well, it's statistically difficult.
So, ripe for a pullback.
Mathematically, yes. Momentum can run further than you think, obviously, but a signal this extreme heavily favors mean reversion trades. It suggests a potentially exceptional risk-reward for shorts if you can manage that tail risk of the momentum continuing. Every point it gets further overvalued increases the probability of a sharp snapback.
Right. Compared to silver's 47%, the other overvalue signals look almost tame, but still worth noting. NASDAQ NQ at 5% you mentioned, mini Dow YM and the 30-year bond ZB both at 3%.
Right.
And the Russell 2000 RTY at 2%.
Exactly. And on the flip side, the undervalue signals. Potential discounts or just areas of persistent weakness where price got really compressed. We already hit crude oil CL at 17% undervalue.
And wheat ZW at 11% undervalue.
Right. The market tends to correct these kinds of dislocations eventually, but the when is always the question. Depends on sentiment shifts or new catalysts. But that massive difference between silver at plus 47% and crude at negative 17% really captures the split personality of the market at the close, doesn't it? Extreme expansion in one area, severe compression in another.
Definitely. Okay, quick review of the gap analysis, too, those overnight or weekend pressure points.
We saw those significant gap downs, signaling strong selling pressure into the open, mainly in softs and FX, corn, ZC, Euro FX, 6E, and wheat, ZW.
And the gap ups, where was the strong buying pressure at the open?
Only two significant ones flagged here, RBOB gasoline, or B, and importantly, the U.S. dollar index, DX. That dollar index gap up reinforces the weakness we saw in the euro and yen.
Makes sense. Okay, back to the core technical picture. Moving average placement. That divergence between the 200-day long-term trend and the 200-hour short-term trend seems critical. Which contracts showed clean alignment, either strong or weak?
Okay, the clearly strong ones, above both MAs, showing both short and long-term health. That's the S&P ES, NASDAQ NQ, Natural Gas NG, Russell 2000 RTY, and Soybeans ZS.
And the clearly weak ones, below both MAs.
Structurally weak, yeah. The 10-year note ZN, crude oil CL, and the Japanese yen 6J. These are under pressure and technically vulnerable.
But that strategic sweet spot, or maybe danger zone, is the divergence group, right? Where the long-term 200-day is holding, but the short-term 200-hour has failed.
Exactly. That's where the most complex risk assessment comes in. And that's the 5-year note, VF, and the 30-year bond, ZB, that we talked about earlier.
So they're basically clinging to that long-term support.
Pretty much. They're relying solely on that 200-day MA. The break below the 200-hour confirms that the recent high volume is coinciding with immediate selling pressure. If that 200-day line breaks, you could see things accelerate quickly, even with the current low IV.
Okay, let's tie this all together with the conviction indicators, buyer-seller power, and the overall trend signals. Where was the consensus strongest daily and weekly?
All right, unanimous signals where the market seemed most decided. 4 instruments really stood out.
Let's start with unanimous bearish conviction. Where were sellers firmly in control?
That would be light sweet crude oil, CL, and the U.S. dollar index, DX. Both showed unanimous seller down direction across daily and weekly views, confirms the weakness we saw in their technicals.
And the unanimous bullish conviction, buyers fully in charge.
Natural gas, NG, and soybeans, CS, both flagged as unanimous buyer UP. This signals that those upward moves seem powered by pretty sustained buying interest, not just a one-day pop.
And the overall trend classifications, the H trend and M trend signals.
Yeah, those are important for momentum context. The H trend, hard trend, signals powerful, persistent momentum. We saw that in the Euro FX 6E, soybeans ZS, and the Japanese yen 6J. These are trends you generally don't want to fight.
And the medium trends? Solid, but maybe less relentless.
Right. M trend, medium trend, was flagged for the NASDAQ NQ, mini Dow YM, RBOB gasoline RB, and copper HG. These show good directional movement, maybe offering more tactical entry points compared to the hard trends.
So using these classifications gives you a strategic overlay, basically. Respect the hard trends, look for opportunities within the medium trends, maybe fade extremes in the no-trend markets if other signals align.
That's a good way to think about applying it, yeah.
Okay, let's try to synthesize this. Wrapping up the core themes from this week ending October 31st. The market close was really defined by massive institutional flows in fixed income.
Absolutely. Bond futures, particularly ZN and ZF, drove the highest volumes we saw anywhere. But paradoxically, with those super low IV ranks between 3% and 9%, it feels more like big structural repositioning or hedging than outright speculative fear or greed.
And we kept seeing that critical technical divergence, especially in the 5-year and 30-year bonds, ZFZB. Holding the long-term 200-day MA but breaking below the short-term 200-hour MA, that's a precarious balance heading into next week.
It really is. And those extreme valuation signals from the true value metric, they're hard to ignore. That almost unbelievable 47% overvalue in silver versus the deep 17% undervalue in crude oil. Huge dislocation suggesting potential mean reversion plays, even if the immediate technicals are pointing elsewhere.
Which brings us to our final provocative thought for you, the listener, to mull over. Given this unique setup, the massive volume in treasuries, that extremely low implied volatility, and the fact that sentiment was predominantly buyer down for these very liquid contracts, what does that really signal?
Yeah, what's the real message here? Is this massive institutional churning with low expected future Volsiade just the quiet before a major storm in interest rates? A big breakout or breakdown is brewing under the surface.
Oh, does it simply mean that big capital is comfortable with the current range, confident it holds, and that low IV is just a green light for them to aggressively sell options premium, collecting yield while things stay range-bound?
The conflicting technicals we saw, especially that divergence in bonds, coupled with strong directional trends in commodities and FX, it suggests that whatever happens next in that core treasury complex is likely going to ripple out and drive everything else.
That definitely feels like the structural challenge the market's left us with heading into November. A lot to watch.
For sure.
And one last reminder. If you found this deep dive valuable, please hit that follow button and turn on notifications. We do this every week, aiming to give you the clearest analysis to navigate these markets.
Thanks for diving deep with us today. We'll catch you on the next one.